Scalping is a trading style that lives in the milliseconds. It's not about long-term vision or predicting the next big market shift. Instead, it is about capturing tiny profits from small price movements over and over again. A scalper doesn't hold a position for days or even hours. Most trades are opened and closed within minutes, sometimes just seconds. The goal is simple: get in, grab a few cents or pips, and get out before the market even knows you were there. It is a relentless pursuit of small, consistent gains that, when added up over hundreds of trades, can become a significant sum. This is the world of high-velocity finance, where speed is everything. Imagine a busy marketplace, with prices flickering up and down every second. A scalper is like a lightning-fast shopkeeper who buys a stock for $10 and sells it moments later for $10.01. That 1 cent profit seems insignificant on its own. But what if they could do that 1,000 times in a single day? Suddenly, those tiny pennies add up to $100. This is the core logic of scalping. It thrives on volatility and liquidity, needing a market with enough buyers and sellers to ensure they can enter and exit trades instantly without affecting the price too much. It is a game of volume, both in the number of trades and the size of the positions taken. Unlike other trading strategies that rely on deep fundamental analysis of a company's health or broad economic trends, scalping is almost purely technical. Scalpers are obsessed with charts, but not the long-term ones. They stare at 1-minute or even tick charts, looking for fleeting patterns and temporary imbalances between supply and demand. They are not trying to predict where a stock will be next week. They are trying to predict where it will be in the next 10 seconds. This intense focus on the immediate present requires a different kind of mindset, one that is detached, disciplined, and incredibly quick to react to the ever-changing flow of market data. This trading style is not for the patient investor who buys and holds. It is a high-octane discipline that demands constant attention and a stomach for rapid-fire decision-making. The scalper's day is not spent reading annual reports or listening to company earnings calls. It is spent glued to a screen, finger on the trigger, waiting for the perfect, fleeting moment to strike. The market is a river of numbers, and the scalper is trying to scoop out small cups of water as quickly as possible before the current changes. It's a game of precision, speed, and sheer endurance, played out in the digital ether of the world's financial exchanges. High-frequency trading, or HFT, is scalping on steroids. It takes the human element out of the equation and replaces it with powerful computers and complex algorithms. These systems are designed to execute a massive number of orders at speeds that are physically impossible for a human trader. We are talking about trades that last for microseconds, millionths of a second. Why is this speed so critical? Because in the modern market, the first one to react to new information gets the best price. If news breaks that a company is doing well, an HFT algorithm can buy thousands of shares before a human trader has even finished reading the headline. This obsession with speed has led to a technological arms race. Trading firms spend millions, even billions of dollars to gain a few milliseconds of advantage. They build data centers right next to the stock exchange's own servers to reduce the physical distance that data has to travel. This practice, known as co-location, minimizes latency, which is the delay in transmitting data. They lay down proprietary fiber optic cables in perfectly straight lines, even blasting through mountains, just to shave a fraction of a second off the communication time between, say, Chicago and New York. In this world, the laws of physics are the ultimate barrier to profit. The algorithms that power HFT are incredibly sophisticated. They are programmed to detect tiny temporary pricing discrepancies and exploit them instantly. For example, an algorithm might notice that a particular stock is trading for a fraction of a cent cheaper on one exchange than on another. It will simultaneously buy the stock on the cheaper exchange and sell it on the more expensive one, locking in a risk-free profit. This is called arbitrage. Other algorithms might be designed to provide liquidity, constantly placing buy and sell orders to earn the small spread, creating a market for others to trade in. It is a complex ecosystem of competing machines. This relentless pursuit of speed has fundamentally changed the nature of the market. It is no longer a place dominated by people in trading jackets yelling in a pit. It is a silent, invisible world of light-speed data and automated decisions. Some argue that HFT makes markets more efficient and liquid, tightening spreads and lowering costs for everyone. Others claim it creates an unfair two-tiered system where ordinary investors are always a step behind the machines. Whatever the case, one thing is certain. Speed is the new currency on Wall Street, and those who have it hold a distinct and powerful advantage over those who do not. To compete in the fast-paced world of scalping, a trader needs more than just a standard brokerage account. They require a specialized set of tools designed for speed and precision. The most crucial element is a direct access broker. Unlike typical retail brokers who may route orders through intermediaries, a direct access broker allows a trader's orders to be sent straight to the exchange or market maker. This dramatically reduces execution time, which is paramount when a trade might only last for a few seconds. It gives the scalper a level of control and transparency that is essential for seeing the real-time order flow and getting the best possible price. The trading platform itself is the scalper's command center. These are not the simple web-based interfaces used by casual investors. Professional scalping platforms are powerful software suites that provide a fire hose of real-time data. They feature advanced charting tools with customizable timeframes, down to the tick level. A key feature is Level 2 market data, which shows the order book for a particular stock. It displays the list of buy and sell orders at different price points, giving the scalper insight into the immediate supply and demand. Seeing this depth of market helps them anticipate short-term price movements and find the best entry and exit points. Efficiency in placing orders is non-negotiable, and this is where hotkeys become a scalper's best friend. Instead of using a mouse to click through multiple menus to buy or sell, a scalper will have pre-programmed keys on their keyboard for instant order execution. A single keystroke might be configured to buy 500 shares at the current asking price, while another key instantly sells the entire position. This shaves critical seconds off every trade, which can be the difference between a small profit and a small loss. When you are making hundreds of trades a day, these saved seconds accumulate into a significant edge over slower market participants. Finally, the physical hardware setup is just as important as the software. A reliable, high-speed internet connection is an absolute must. Any lag or disconnection could be disastrous. Many serious scalpers use multiple high-resolution monitors to display all the information they need simultaneously. One screen might show a 1-minute chart, another the level 2 data, a third might track overall market news, and a fourth would be dedicated to order execution. This multi-screen setup allows the trader to process a vast amount of information at a glance, enabling them to make the split-second decisions that define the scalping strategy. It is a digital cockpit for navigating the market's turbulence. The primary reward of scalping is the potential for consistent daily profits, regardless of the broader market direction. A long-term investor might have a bad month if the entire market goes down. A scalper, however, doesn't care if the market is bullish or bearish. They thrive on short-term volatility, the small up and down ticks that happen every minute of every day. By successfully executing a high volume of small profit trades, they can build a steady stream of income. This strategy offers a high frequency of feedback. You know very quickly if your approach is working, allowing for rapid adjustments, which is a powerful advantage in itself. However, the risks are just as pronounced and immediate. The most significant danger is the cost of doing business. Every trade incurs a commission or a fee, and since scalpers trade in high volume, these costs can quickly eat away at the small profits. A few losing trades in a row can wipe out the gains from dozens of successful ones. Another major risk is slippage, which occurs when the price you get is different from the price you expected. In a fast-moving market, by the time your order is executed, the price may have moved against you, turning a potential winner into a loser in the blink of an eye. Scalping is certainly not for everyone. It demands a specific personality type, someone who is highly disciplined, decisive, and emotionally resilient. You cannot get attached to any single trade or become flustered by a string of small losses. A successful scalper must be able to execute their strategy flawlessly, almost like a machine, without letting fear or greed cloud their judgment. It requires intense focus for long periods and the ability to make hundreds of decisions under pressure every day. This high-stress environment can be mentally and emotionally draining, making it unsuitable for traders with a nervous disposition or those who prefer a more relaxed approach. For beginners brave enough to venture into this domain, a few tips are crucial. First, start with a trading simulator or a paper trading account. This allows you to practice your strategy with real market data, but without risking real money. Second, master one strategy on one or two highly liquid stocks or currency pairs. Don't try to trade everything at once. Focus is key. Finally, and most importantly, practice strict risk management. Always use stop-loss orders to define your maximum loss on any given trade, and never risk more than a tiny fraction of your capital on a single position. In the game of scalping, survival comes first, profits come second.